Hi, I'm Peter Lundgren, founding CEO at Lundgren's Capital.
And I'm Mel Lopez, Chief Economist for ASEAN.
Welcome to Sound Economies with Mel and Peter, an East meets West podcast by Lundgren's Investor Insights. Here we share what we're focusing at in economies and financial markets from the developed and the developing world. Hello, Mel. How are you doing today? How's your week been so far?
Hi, Peter. A lot of projects, moving parts here in Manila going on. We're working towards our next publication. So it's an exciting time. And we are also looking forward to, well, I guess more content on the Lundin's Investor Insights website and app, Peter. How about you? How are you so far this week?
Yeah, I'm good. It's busy and investing is interesting these times. Yeah, and I know you are busy on sort of the production and content production. I'm pushing a bit there, so even on that area, I'm very excited. But that will be probably a story when we sort of maybe 1 month from here. Yeah, let's see.
Yes, yes.
So we will keep quiet about it. So until then, see what happens. Anyway, today interesting things on the agenda. We have the Chinese EV car maker BYD diving a bit into to what they're up to, and then we
Mhm.
have some fresh news out of Indonesia that we will just touch base on. It's not dramatic. It's not market mover. We just noted. And then we'll do a US dollar check, sort of just checking what's happening on the dollar, and then going global again, looking into the latest OECD report. There are a couple of interesting takeaways there as well. And of course, always we sort of round up and saying, okay, how much sunshine is out there in the market? That we'll see. Mel, you go first here with the Chinese EV maker BYD. What are they up to now?
Right. So actually, they surprised markets over the past week by dramatically bringing down the selling price of the BYD electric vehicles and hybrid cars as much as like over 30%, especially for the entry level vehicles that they're selling. Um, and it's actually quite a surprising move considering that BYD is really performing well, not just in mainland China, but globally. They are enjoying at least a 30% market share in China right now. But it seems that they're not satisfied with that and they want to take even more. Um, their Seagull, so that's their entry point EV is like below 8,000 US dollars with the discount. So it's actually very attractive as far as capturing mainland customers are concerned. They're an industry leader, and it seems though that they're out to get the smaller competitors in mainland China. And of course, the Chinese regulators are taking notice. They
Mm.
do not like mega monopolies, and we've seen that
Yeah.
happen before. And the car industry associations in China are also pushing back against BYD, basically telling them that this artificial competition is unnecessary or unfair. So it is unsettling to see, but we take note of it because a lot could change. BYD has been very rapidly growing globally. It's displacing
Mm.
Tesla in terms of the biggest sales of EV cars in the world. So
Yeah.
it's quite a surprising move, Peter.
Yeah, it is. It's remarkable. It is interesting to actually it's interesting to follow. Also, the
Mhm.
battle against Tesla, of course, that is something that everybody understands. But even as it is also fascinating that internal in China, that manufacturers are complaining about sort of the competition, yeah, and unfair competition. That is sort of what the Europeans have been complaining about for decades, yeah. So that is quite fascinating alone that. But as we were talking about BYD, I just had a look at a couple of stock charts because it is a fascinating story, so to say.
Mhm.
If we look into the past 5 years, BYD, the stock has gone up with around 500%, 500%
Wow.
in local currency. Yeah, and that is one thing. But if we compare to where all the cars were manufactured for not
Mm-hmm.
many years ago in Germany, the BMW stock is up with 30%, 30, and the Volkswagen, the VW, is actually down with 30% during these 5 years, or to be precise, 37%. The price earning for the BID, that is the ordinary share in trade in
Mm-hmm.
exchange as in domestic China, is at 23 and a half, where the price earning on VW is 5. That
That's
is,
so far.
that is it's and this is sort of a historical shift
Mm-hmm.
in the market, as we have seen it before. So there's the old people, some would remember the Kodak story, fantastic, famous camera producer listed on as in Dow Jones index and everything. They lost everything and actually filed for bankruptcy. Also because the market shifted away from them, and this is a bit sort of a half the same story, and it's fascinating. And of course, investors will consider, okay, so what should I buy? Should I go and say five? A price earning on five is fantastic. Is it cheap? Yeah.
Uh-huh.
My old professor on IMD in Switzerland, the business school, Nuno Fernandes, he taught us how to go for the high P valued companies. And one of the reasons is, yeah, of course, investors they are, so the market is simply the brightest, and the market is
Mm-hmm.
foreseen further growth. Yeah, but there's also quite a lot of other arguments for focusing at the high PE value companies. Now, this is, as you also touched, this interesting phenomenon in China. Of course, the Chinese government, they like to favor, and they like their own Chinese companies.
Of
That is
course.
the same. Any government in the world, they prefer their own national companies. So there's no surprise there. But they don't like, as you say, this power concentration that a money power concentration can illustrate as well and be. And we have seen of the very big digital giant Chinese companies
Right.
where it was too much all of a sudden for the Chinese government. So there is another hand playing here in the market, and as investors should consider, that is, it can actually be that the sky is reached for BRIG because
Mm-hmm.
the Chinese government is sort of they are looking closely into this. There might be a barrier, and that is worth to notice. But fascinating story.
Yes.
So fantastic. Otherwise, let's stay in your region in Indonesia. Is it worth to notice what they just announced?
Yeah, so actually, just today they started rolling out a $1.5 billion stimulus, consumer stimulus. So it's mainly going into subsidies and discounts for transportation fares and toll fees. I guess they want people to take a vacation, and 2 month wage subsidies,
Yeah.
social aid as well. Their main goal is really to perk up growth after a
Mm.
disappointing to them, 4.9% GDP growth in the first quarter. That would be a
Yeah.
dream for economies in your side of the world, Peter. But here, they
Mm.
don't like it that much. They want to take it to 5 to 8%.
Yeah.
So
Yeah.
yeah, that's really it, Peter. And um, but I'm not sure if I don't think transportation subsidies will be that big of a factor, right?
No, this is as we consider this is as a small thing, yeah. But we take it up because the reason why we sort of take it up, this is so small, $1.5 billion US in Indonesia. Of course, it's a lot of money in the country as such in absolute
Yes.
terms, but compared to the total GDP size, it is nothing. I say it's rounding. It's
Mm-hmm.
0.1%. It is just to smoothen out a bit on maybe the low incomes. It is basically aimed to help some low incomes in the next couple of months, saying okay, transportation is lower, cost is lower, and some other subsidies. What we were discussing, could we see it as a sort of first step where Southeast Asian countries they try basically to again compensate against the tariff haywire from US. And will we see more? Could we see more across the Southeast Asian countries saying, okay, they are pumping up now? Do they start, or is this just sort of a small thing?
Well, we've seen Thailand roll out a similar stimulus package a few months back, but it's not necessarily in response to the tariffs, but basically slow domestic consumption. This
Mm,
is more of the same as far as Indonesia is concerned. And actually, Thailand's was bigger. I think that was close to 10 billion. This is 1.5.
yeah,
So that's
yeah.
very small. Anything to move the dial, you should go big, right? But in this time, I think it's more politically driven. We've discussed in past episodes how doubt or like uncertainty towards the policies of the new Indonesian president Prabowo isn't too
Mm,
popular versus
yeah.
his predecessor. So it's really more of like trying to win more voters. Well, not voters because he already won, but trying to win more people over to his side to support his policies more
Mm.
than really just pushing GDP because as you said, it is quite small.
Very interesting. We took it on the agenda because it's so fresh. It's just basically announced, so to say. But we are not so far. We are not excited. No reason to rush out and buy more stocks on that reason. At least
Right.
there could be other good reasons, but this is not sort of a market mover. We need more of that, and right now, as you say, it's not really in the cards. Several Southeast Asian governments are holding a bit back on just to do more spending, and
Mhm.
so this is where we are now. We have put on the agenda what we call checking the dollar rate, because we
Yes.
do that now and then. The dollar is, after all, the biggest, absolute most important currency in the world, and it is the only currency we can consider as a reserve currency.
Mm-hmm.
There are big dreams in Europe, in the European Central Bank, that the euro one day should be a reserve currency. And of course, there are all the wet Chinese dreams about the same. Concerning China, it will never happen as long as renminbi is not free floating. Concerning Europe, we are sorry, but the view we have on Europe is that it's a shrinking area relative seen. So there's no, it's very hard to qualify as a reserve currency. So
Right.
there's not that we are in doubt about the US dollar will continue being a reserve currency, also despite what happens in the Oval Office of all crazy stuff. We know that some countries has pulled back from the dollar, also China.
Mhm.
But it's still, we're not putting the dollar as such in doubt. But what we are looking at is, of course, the dollar rate and the movements. It's always good for investors. As if we hit the dollar right, yeah, then we have
Mhm.
done a lot good for the portfolios, for yeah, for the return in the portfolios and so yeah. We last time we revisited the US dollar was in February. I'm European based, so we are happy to look at the US dollar against the euro, of course. At that time, the euro against US dollar was trading at 103. Our sort of view was that was sort of the low end of the range, meaning the low end of the range for the euro against the US dollar, but also for currencies in general against the US dollar. If we turn it around, then it means that it was a high end of the range for the US dollar as such. That was sort of our conversation at that time. And why was
Mhm.
that? There'd been some, in general, good mood about US still, and investors were fairly long US dollar in active positions, well loaded with US assets. And then on top, there was sort of the positive US dollar trades, believing that Trump will lead to a lot of good things, yeah, and that would be very positive for the U.S. economy and the U.S. dollar that Trump was taking over the Oval Office. So that was at that time the situation, and as
Yeah.
well, we consider the broad range for the U.S. dollar, and if we express it again against euro, as something like 102.5 to 122.5, and a bit more narrow range that a band it trades within is like 107.5 to 117.5. This is how we actually consider the bit more narrow and the outer range of where the dollar could trade against the euro, but it also reflects about sort of the rest of the world. There's so far no fundamental news that that leads to believe it can break out of these very broad ranges.
Yes.
And we were at the very low end of the euro dollar range and saying, okay, we do have a lot. We could see there was a lot of positiveness surrounding the dollar and active trades being long dollar, and that has turned around. And now then we need a pat on the shoulder, because as a noun, it's not always we were right. Yeah, and this one we were right on. So a pat on the shoulder to us, as we recommended to go out and sell off some US dollars if that was an option. And now we are trading somewhat higher in the US dollar.
Yes.
Around 10% actually, and that is quite a lot. It's quite a lot in 4 months. And we could see, as we can still see, as what we observe for conversations with all kind of investors, is that people are still tendency to take money out, as a reduce investments in US, and that is actually what we see. So there'll be some more capital flows out of US. That is what we expect. So another 45% to go in the dollar on the downside. That's actually what we're looking at. But we are not talking about the sort of a dollar crisis. It is a pretty large moment within a sort of a fairly short time, but also reflects that President
So
Trump
much.
is actually making a lot of havoc in the economy. Yeah. So this is how we see it. Another 45% lower for the US dollar. We will sort of do a dollar check again if we're right. If it goes 45% the other way, we will also do a dollar check, and then there's not so much pat on the shoulder. So this is the next time we'll do something. Okay, but it is interesting and always good to have the dollar trend right. And it is not always so easy, but it's means a lot for investors. Good. Let's stay a bit global, Mel, and also some interesting report, global report from OECD. They're also touching US and the dollar actually. So let's take off there.
Actually, Peter, what's unique about the OECD report is how candid they are about really all the tariff talk being the dampener really globally, and how hard US assets are hit across the board because of their own policies. Of course, the similar to major think tanks and associations, they downgraded global growth outlooks for the year. They're at 2.9 from 3.1% previously. But they mentioned specifically that the slowdown is concentrated to four countries. So US is the biggest concentration, China, Mexico, and Canada. And all this tariff talk is really like maybe bulk of the report is really discussing that the tariffs, the retaliations, the uncertainty of the discussions from the White House. It's really what's behind all of this. And a key takeaway there is that financial market conditions remain tight, so much so that the dollar, the US stocks, US bonds are all undesirable versus before to global investors. Stocks, particularly of companies with either large US exposure or US companies with heavy international exposure, they are really the biggest so-called victims of this capital pullback or capital outflows from out of the US. So US assets, including the dollar, is not really, the safest that they see anymore as far as investment avenues or vehicles are concerned, and that US stocks have underperformed versus their global peers. So it's really, I think, a more uh, frank or like open discussion about how everything is really in a mess because of the tariff war from just that started in February. These forecasts were, came a bit later than their counterparts like the IMF and the ADB. So a lot more of the tariff talk has been factored into these figures. And yeah, that's interesting to me because they point to stubborn inflation persisting that is
Mm.
holding back the Fed and major central banks from doing their supposed rate cut. So, like our house view, they also don't expect the Fed to cut anytime at all this 2025. And yeah, at the time when uncertainty is this high, you would
Yeah.
really just wait and see. And unfortunately, that does not benefit US assets at all.
No, and it is, you say it's remarkable, some of the comments actually come with. Um, so OECD, now then, they are pretty frank about what they cover in the world. But still, it is US they're covering.
Yeah.
It's not a small country here. And also interesting that they're very straightforward on the expectations to a no rate cut from
Mhm.
Fed this year. We welcome them in the league, yeah.
Yeah.
But also the view on US assets in general, that
Mhm.
they actually are in doubt about US assets, that not they're not forecasting the US is going under, yeah. But it's just that they actually then doubt about looking forward on US assets. So they simply see it's very risky. This is remarkable. And for sure, I cannot remember each and every OECD report going 40 years back. To apologize, but this is sort of say, okay, I cannot necessarily recall that we have seen
Mhm.
this kind of remarks about US, yeah, from OECD. And this is so it shows that uncertainty about the U.S. asset market is not just something we discuss in financial markets. It's discussed among investors. It is actually going out in each and every corner of the world. This the uncertainty is very broad based, and that will take time to recover. Even if we said today things will improve, from today it will take time to recover.
Mhm.
Uh, but we are not recovering. So the uncertainty, and also as we talked about when we did the dollar check, it's more likely that investors are pulling out of US still. And then the good question is, so where are they going? And parts going to Europe for sure,
Yes.
and but also a part is going to Asia. And I actually think that Asian and European investors, they will go more back to their own regions. So good, but that was the OECD. Remarkable comments from these guys. To circle back to our own
Yeah.
humble outlook, yeah. And can we continue to trust in the sunshine, Mel?
As you mentioned, Peter, investors, foreign or global investors, are likely to go back home to their own region, to their own
Mhm.
countries, amid uncertainty, amid great uncertainty towards the US. So, as far as Asia, there is a lot of growth going on in this part of the world. We've heard earlier that countries like Indonesia is trying to perk up domestic consumption to lift growth prospects further. So for investments, that bodes really well because you want to look for sustainable growth sources at the time when your typical option is as
Yeah,
risky, not or riskier versus before.
yeah.
So as far as growth, there is still a lot of potential and a lot of growth happening towards Asia. China is also chugging ahead despite some hiccups. So it is a promising outlook out here, Peter.
Yeah, also we need more bigger things to be shaken in our fundamental view that the world is actually strong. We
Mm-hmm.
fully recognize that the global GDP growth is pressured. Of course, it is. U.S. is the biggest economy, and if they're also the biggest economy itself is moving a bit down, but the president is also trying to block cross global trade. That of course has a temporary negative effect. But households out there, they're on the move forward, and a lot of governments, they do have more maneuver room. question, when do they want to make it active? That's another story. We have the fundamental view that we actually see more sunshine than anything else, clouds on the horizon, or for sure. But we remain in the having more risk than neutral. We have for a long time ago cut our allocation to US to become neutral from overweight, yeah, and again prefer some non-listed stuff, alternative investment, particularly in Europe. So this is still our main view. We are okay with the credit markets. We do listen to the concerns about the credit market, and actually, what is a concern? It is that the credit spreads are not wide enough, meaning it should be more expensive for, let's say, companies, maybe emerging markets, to borrow in the bond market. We are not so sure that it is the correct assessment. So we are happy. We're actually happy with also credit risk and risk in general from the fixed income market, sort of in the middle of the curve. So yeah, we stay overall positive on the world. There are more sunshine than clouds on the horizon. We are fully aware of the different challenges, but anyway, in total, we're still happy, and I hope we'll stay happy for the next week, and also that the listeners will stay happy. So thank you to the listeners for joining today. Also to you, Mel, for joining.
Thanks, Peter, and thanks to our subscribers.
We will be monitoring global developments and will share what's interesting in the next episode of Sound Economies, Mel and Peter on the Global Financial Markets, a podcast by Lundgren's Investor Insights. Thanks for tuning in. For expert insights on the go, download the Lundgren's Investor Insights app for free. For investors, we offer very exciting and high quality alternative investment funds, including our top-rated mutual China fund. To know more, visit lundgrenscapital.com.